Recently, I had a client ask about modeling a retirement strategy that did two really important things. The first, model Roth conversions before RMD age, and the second, model large charitable gifts while they're alive. Their end game? Reduce regular IRA balances and reduce total taxes. After working this over with them, we landed on a unique approach that gives the best of both worlds. So if you're curious how this worked out for them, stick around until the end, because in this video, we're going to look at an example of a strategy that can help you maximize your Roth conversion efficiency while you're maximizing your generosity. But first, I'm Curtis Crossland of Suttle Crossland Wealth Advisors, and the purpose of this channel is to discuss financial topics and ultimately help people build more tax-efficient retirements. So let's get into it. Now, these two goals in and of themselves may not sound like anything new. In fact, you might be asking the same two questions yourself. Are there any benefits for me to do Roth conversions? And I'd like to give back, but what's the best approach? Well, in each case, understanding the impacts are essential to understand the when and the how. And as I've shown in other tax planning videos, and feel free to check some of those out next, when you choose to do something and how you choose to do it have a huge effect on your tax planning. So what we're about to look at is how your gifting goal can be used together with your conversion goal in a great way. And if this ends up being a topic that resonates with you personally, consider talking with a professional, as this video is just meant for educational purposes. And whether you're a fan of the channel or new to the channel, I'd certainly appreciate a subscribe, and it'll help other folks find videos on topics that might help them. Now on to the example. So let's meet our couple for the day. We've got Joe and Jane, and let's take a look at some of the numbers related to their situation so we can get an idea what they're working with and how things are going to come together for them. Now, both are going to be age 63. We're also going to look at a planning horizon of age 90, and so this gives us about 27 planning years to deal with. Additionally, for their tax status, we're just going to say they're married filing joint, and there's nothing else out of the ordinary with that situation. Now, if we jump over and we take a look at the net worth, we can get an idea on some of the numbers they're working with as well. They've got a pretty good amount in the bank here, just checking and savings, something for a rainy day, plus something just to keep the lights on month to month. But down here in the investments, we can see they have a little bit more to work with. They've got a pretty good amount in a taxable brokerage. And then as we can see, Joe's got a pretty sizable amount in a pre-tax IRA. Jane's got a pretty good amount as well herself in a regular IRA. Couple other quick details to note. We've got a total net worth right over $4 million. And then as far as property goes, they do own their home, but they don't have any other rental properties or any other investment properties. So really what they have entering into retirement is kind of everything that you see here, plus Social Security. And one other thing to note is you don't see any debt. They're actually going to enter into retirement without any outstanding loans, mortgages, etc. Now, if we pop over here and take a look at their goals, we can see what they're trying to do. They want a budget for $8,000 a month in monthly expenses during retirement. They also have a vacation budget where they want to spend $20,000 a year for vacations for the next 10 years. Now, for healthcare costs in retirement, we're looking at some national average numbers here, but we're looking at it in this way to include, just in case there's any consideration towards things like Medicare's IRMA or other costs associated with healthcare as they age. We can see that they also have a new car every 5 years goal. And then the big one, we do see a large charitable giving goal of $500,000. What it is they wanted was to give more, specifically an amount that aligned with their values and how it can fit within their retirement as well as their family needs. Now, sort of a secondary consideration, they do want to give more when they pass, but at least for now, while they're alive, this is what their intent is. So again, in this example for Joe and Jane, we're using $500,000 as the number that they want to gift during their lifetime. Now, a couple important things to note as we look at income. I have both of them showing Social Security starting age 70, but we can see that their full retirement age benefit amount for Joe, we've got just a little bit over $3,000 per month. And then for Jane, we've got just under $2,000 per month. Now, they've decided to do Social Security at age 70 for a couple primary reasons. A big one is going to be survivorship, but really from a strategic standpoint, they want to give themselves more years where they can consider Roth conversions. And outside of just being generous year to year, they do want to have a few years of being in retirement before they make a large gift, just to ensure they're not going to run into any issues. Now, when we first get a look at the Monte Carlo, we can see that they're going to be fine. In fact, more than just fine, even with the large $500,000 gift that they want to make to charity at age 70. Probability of success is showing up here at 100%. And as we can see, the median terminal balance is several $million. Now, when we go and we take a look at their total tax projection, we can see that they have an estimated total tax payment in their lifetime federally of just over $2 million. Additionally, when we look at the ending account balances, we see a huge percentage still of regular IRA and no Roth IRA. Now, when we go over and we try to run the solver to see what it's going to tell us on how we can try to get the highest tax adjusted net worth at death, we see that we can accomplish that by staying within the 12% marginal tax bracket. Now, even though this is likely not a big enough number as it relates to trying to totally eliminate the IRA balances, let's see what starts to happen if they consider it. So back over here, if we change the conversion level up to the 12% marginal bracket, well, here we can see they're going to have a higher or more tax adjusted ending assets. We're also going to see a pretty considerable reduction in those total federal taxes paid. So instead of having somewhere in that $2 million range like we can see right here, it's a little bit closer to the $1.5 million range. And instead of having somewhere in the neighborhood of 16.3 million net worth at death, they're closer to 17.1 million. Additionally, if we take a look at the composition of the accounts, we see that roughly a third of the accounts are now considered Roth assets at death. So this is actually huge for non-charity beneficiaries. So now this is doing what they want, but this is where the strategy can take a bit of a turn. And what I'm talking about is doing gifting on the basis of using qualified charitable distributions. You recall earlier, their goal was to start gifting around age 70. And this is where a little tweak to how they actually want to do this can actually make a pretty big difference. So if you take a look at what a qualified charitable distribution is, this comes right from the IRS. It basically says that a qualified charitable distribution, or a QCD, is a non-taxable distribution made directly by the trustee of an IRA to organizations that are eligible to receive tax-deductible contributions. A little further down, it says that making a QCD, or qualified charitable distribution, can benefit the taxpayer by reducing their taxable income while they support qualifying charitable organizations of their choice. The person gifting doesn't then have to worry about meeting the standard deduction or itemizing deductions if they're doing a QCD. Now, a couple big requirements here. Taxpayers who make a QCD must be at least 70 and a half years old on the day of the distribution. But this next one here, and this is huge, a QCD, a qualified charitable distribution, will count towards a required minimum distribution. So when you look at strategies to combine this with conversions, this is where it starts to get very interesting on what's possible. So let's instead say that we're going to make that $500,000 donation, but we're going to do it over a series of years using that QCD availability. So what we're going to do is we're actually going to come over here. So instead of doing this one-time $500,000 donation, we're going to say, well, let's do $50,000 donations, but let's do it over the course of 10 years using that qualified charitable distribution availability. So let's take a look and see what happens if we spread it out over that 10-year period. And while the numbers on the right are looking pretty similar, I want us to pay attention to something very carefully here. If you recall before, when we were doing just the Roth conversion with the single one-time $500,000 donation, our projected tax-adjusted ending net worth was about 17.1 million, but now we can see it's about 18.2 million. Additionally, when we looked at the total amount of taxes paid before the conversion, I think we were closer to the 1.53 million in terms of doing the conversion, but now we're about 1.6 million. And so even though we have a roughly $500,000 less taxes paid number showing up on the right, the reason we're seeing a little bit more in terms of the total tax to do it this way is if you do a single donation, a very large donation in 1 year, that's going to greatly reduce the amount of assets that are available to you. And when you compare that to something where you're actually retaining or keeping the asset, especially if quite a bit of it is still going to be an IRA value, well, then you're going to have slightly higher projected total taxes on the basis of not giving away more of your net worth, at least initially. So bottom line is this is still very positive. So even though there's a slight increase in the amount of total taxes paid compared to doing a single donation, the benefits here are you get to hang on to more of your money longer, just in case there are curveballs life will throw you or things get crazy out there in terms of the financial landscape or global landscape. This seems like a very fair trade-off in terms of 1.61 million versus 1.53 in terms of total taxes, relative to the idea of having a $1.1 million higher projected tax-adjusted ending asset net worth. Now, noticeably, we still also have roughly a third of the portfolio that will end up in Roth assets at the end. And again, that's a big deal, especially if you're seeing total net worth numbers that are big like this one. So I want to stop for a moment and just talk about how the strategy actually works. Well, it works on the premise that if you're using QCD years to make charitable gifts, it's far more efficient because it actually accounts against RMD requirements. When that's the case, there's going to be less income that you have to claim in the year that you're doing doing those charitable gifts. And so that's going to mean less in total taxes that you're going to have to pay, but there can also be trickle down effects. If your income is lower because you're doing these qualified charitable distributions and because your RMDs are either lower or eliminated, you may also be able to avoid things that might push you into higher unattractive things like Medicare's IRMA or net investment income tax or the loss of certain credits. And especially in an example like this for Joe and Jane, since they aren't completely eliminating their pre-tax IRA balances, they will have to deal with RMDs. And those can continue to take out a bite of their numbers as time goes by. So if we take this a step further and we play a little 4D chess, we can intentionally plan to convert and use QCD gifting in a strategy that might eventually eliminate pre-tax IRA balances altogether. And so this is huge for beneficiaries and the tax efficiency for them. So if something like that matters to you, then watch what we can work out here. This is where the magic comes in. So I want to come back over here and I want to push the bracket level up to the 22% level so we can actually see what's possible. Now, before we take a look at some of those other tax numbers, I actually want to jump over here and make one little alteration. I'm going to increase the number of years by 1. So it's $50,000. We're looking at an 11-year rollout on that. And then I want to jump us over here into the cash flows. I want to look very specifically at these IRA balances as time unfolds on this strategy. So if we come down here, and again, we're saying we're going to try to convert up to that 22% bracket instead of the 12, and we're going to do those $50,000 qualified charitable distributions starting at age 71. Well, truthfully, it's 70 and a half, but we're going to say age 71. Now we can start to see what is possible here. So we can actually use those QCDs up until the point where Jane's IRA totally runs out of money. Now we are in those RMD years still in the 22% bracket, but if you notice, if we stay diligent with the conversion strategy, we're actually able to get to a point, assuming we live long enough here, that we can get those IRA balances to 0. Now, could they do this faster if they were far more aggressive with their conversions? Well, yes, but we're looking at this as something of a middle ground. So now when I come over here and I actually take a look at the tax adjustment on some of these numbers. So if you recall before, we were somewhere around 18.2 million on that tax adjusted ending net worth at death when we were converting up to the 12% bracket. So this is a little bit worse, but look how big the differential is in terms of the total taxes paid. We were able to lower that from the $1.6 million number down to the $1.2+ million number. That's a huge amount of federal taxes saved. So what's the practical application here? Well, generally speaking, taking advantage of qualified charitable distribution years when you're charitably inclined means that you can take a bite out of the RMDs, or you might be able to cover them entirely. And you might say, well, couldn't Joe and Jane just do none of this and just give to charity when they're dead? Well, yeah, but that's not what they want to do. But you could also argue that there might be a better benefit to charity for them to take steps during their lives to increase their total net worth, possibly using conversions or qualified charitable distributions to make a difference. And charity can get even more when they're gone if that's what they ultimately want to do. But the final point to make on a strategy like this is that for some, it may be possible to heavily convert in years leading up to RMD years and purposely leave an amount in an IRA that you intend to give to charity over a period of years. The benefit here would be less money converted early on since it's being saved to give away during qualified charitable distribution years. Think of it this way. If you're the type of person that was trying to get everything from IRA accounts over to Roth IRA accounts, you could specifically target an amount that you don't convert. So in an example where you have, let's say, $3 million of IRA money, converting all $3 million of those dollars, whether it's over the course of 7 years to 15 years, is going to have a tax cost. But if you instead said, well, I am charitably inclined, I intend to give anyways. Well, now you can carve something away from the IRA account. So instead of, in this example for Joe and Jane, we said, let's do 500,000. Imagine instead of trying to convert $3 million, you're really only trying to convert 2.5 million. And if when you look at what you're going to gift during those QCD years, you might be able to choose a stretch of time where each amount that you're going to give is going to be sufficient to cover to the very least the RMD amount for that year. So the benefit here is you're converting less early on, and then the gifts that you're giving later will cover the RMD so you don't have to then recognize that income at some point in the future. And this really does mean that it could be possible to get the best of both worlds. Now, just because you give money does not mean you have to do conversions, and just because you do conversions does not mean you have to gift money. But if you are charitably inclined and you intend to give financial gifts, using those years can give you a way to reduce the amount that you're going to have to convert by strategically leaving it in an IRA account to be gifted out and count towards the RMD, so you never have to recognize that income. So as we saw in this example, combining tax-advantaged actions related to financial goals takes some work and analysis, but digging into these areas can help you make your most informed decision on what you want your money to do for you. And let me know down in the comments what you think. Are any of these strategies new to you? What are you doing with your financial decision making? What are your pain points? Are there any topics that you think that I should cover next? I definitely want to hear from you. So again, let me know down in the comments. Who knows? Maybe I'll cover a video on your topic next. And again, if in watching this video, it made you feel like this topic was speaking directly to you, but you have no idea where to start, you might want to consider if it is time to start working with a professional or not. You can always check out our links if you're so inclined. And if you got anything out of this video, I'd certainly appreciate a subscribe. Once more, I'm Curtis Crossland, and if you want to see how we help folks build a more tax-focused and efficient retirement, be sure to check us out at SuttleCrossland.com and subscribe for future videos.